Thanks everyone for joining today's webinar on our latest investment opportunity, the Village on Summer Street in Orange. Before we get started, just a bit of housekeeping. Today's webinar should go for roughly 20 minutes. If you do have any questions through today's webinar, please do so through the Q&A box at the bottom. We'll answer the questions ongoing. We do have a Q&A session at the end, and for any that we don't get through, a member of our team will be in contact afterwards. Just to introduce the speakers for today, we've got on the screen here Jonathan Wolfe, co-founder, executive director and CIO at Centennial, and Christopher Day, co-founder, executive director of our joint venture retail partner, Parkstone. John, I'll hand over to you just to provide a bit of an overview on the opportunity itself.
Thanks, Dylan. Yeah, and thanks everyone for joining us. I think this is really a great deal. When I look at retail assets, I focus on two things. One is growth. This asset is in the middle of town in Orange, which is a real growth area of New South Wales. It's had pretty rapid growth, which we'll touch on over the last couple of years, and that's really good for regional for retail sales. Sorry, and I think holds this asset in pretty good stead. The other thing I really like is the risk return profile here. Here we're kind of buying an asset which will give investors an income distribution of roughly 7%. But as you can see from that picture, there's quite a bit of vacant land. You see those grassy patches there in kind of the bottom left of the asset, and really that provides a very good platform to value add on this asset, and really we're going to be developing some retail in that space there, and that really helps drive the returns of this asset and really get a mid-teen IRR. And in terms of development, it's no basement, single story development, very nominal planning risk, and so I look at that and go, the return profile here is pretty attractive for the risk you're taking on. So I might just pass over to Chris, and he'll talk through a bit about the deal and how this asset came about, and then talk through some of that value add strategy, and also a bit about Parkstone. Thanks, Chris.
Thank you, John and Dylan. So in terms of Parkstone, this is the second partner deal we've done with Centennial. We're an Adelaide-based retail property business, established in 2018. Our key executives have experience in a number of retail institutions, including Wesfarmers, Woolworths, and Charter Hall. We plus development, banking, and finance. So we all do our bit. Got 6 assets spread across the country, shopping centres, multiple states, predominantly Queensland, New South Wales, with access to over 125 tenants in the portfolio.
Yeah, thanks, Chris. And as you can see here, I understand that you've got a few assets in Orange and the surrounding areas as well, so you know the town really well. Are you able to just provide a bit of an update or background on Orange?
Yes, Dylan, we've been active in Orange for 4 years. The site you can see in the background with the Parkstone logo is the Woolworths that we bought there 4 years ago, which has been a very good asset. When we bought it, it was doing low 50s. We do focus on strong performing supermarkets. This is, I think, our best one in the portfolio, doing almost $60 million in turnover. So we're very, very happy with that investment. We spent a lot of time in Orange. We know the council, we know the CEO, we know the BDMs with the council. We understand Orange and we like the demographic. We think the demographics work really well for retail, good quality offerings like this one, as well as the Woolworths. And we've discovered that there's a number of drivers behind Orange. You've got the gold mine, which is not far off, a lot of tourism, public service, PERSA, healthcare. It's a university town with a lot of students. So it's pretty wide-ranging, Dylan, in terms of the growth factors there. And you've seen, I think, housing go up by 70-odd% in the last 4 or 5 years, which is another thing that we track when we look at going into these locations. So Orange ticks a lot of box for these types of investments.
Yeah, thanks, Chris. I can see a lot of the strong growth sort of drivers there. I know you talked to Location IQ around trade area analysis, and did they provide anything on future supply and any potential impacts that they may have on these two centres?
Surprisingly, Dylan, there is no planned future supermarkets for Orange. So, which is maybe a bit of a surprise, but we're very, very comfortable to see that information come through.
No, perfect. Thanks. And in terms of the acquisition of Village on Summer itself, did you want to just give us a background on the deal, how it came about, the vendors, and a few of these key stats?
Yeah, so the opportunity came about through a campaign that wasn't successful. There were a couple of purchases floating around at high numbers that could have transacted, but we landed on the price at a touch over 37 million. In terms of the vendors, look, the vendors have it's a joint venture. I think they've moved on with other projects. They've it presents really well. They've done a great job in terms of its appearance and aesthetics, and I think they've just moved on to the next round of projects for them, Dylan. In terms of the centre itself, it's located on Summer Street, which is also the A32, so that's the main road going into Sydney. So great profile and publicity. It's the largest single land holding, and this drone shot shows it beautifully. So you've got Summer Street in front of you, Sale Street to the side. You've got the access coming off of Summer Street as well as Sale Street. Then you have a car park adjacent to the IGA, which gets used. So 2 entrances into the short mall. You've got the Dan Murphy's sitting next to it. The combination of IGA and Dan's is outstanding. Very hard to find that. I doubt there's probably one in Australia, actually. And then you've got the loading dock, which is accessible at the back, so separate, so you haven't got trucks mixing with vehicles. So very clean operating in that regard. 2 hectare site being the largest single piece of land in the CBD, and with 5,000 square metres of building, which includes a mini major and 10 shops. So 5,000, Dylan, is roughly, that's a good size for a neighbourhood convenience-based shopping centre.
Perfect, thanks. And in terms of the centre's makeup and tenancy, where the income's coming from here on the slide, do you want just to talk about this and why that flow and layout works well within the centre as well?
Well, as you can see, the Dan Murphy's is in the top 10% most profitable stores in the country. So you've got most of the income coming from IGA and Dan Murphy's taking up most of the centre. I think that plan shows it really well in terms of short mall, 2 entrances into the mall, very good car park, as I said earlier on, with a number of those shops facing onto the car park, and they're food-based. So that worked really well. And then you can see that the development land there is highlighted in yellow as well.
Yeah, perfect. And on that developable land, I've got a slide here just on that strategy itself. Do you want to talk us through the development and what you've gone through and proposed expansion site?
So we've allowed Dylan 2 years for the development process. So 12 months to get the approval for that scope of works. So ideally, or most likely, three new tenancies, 3 separate buildings. So 12 months to get the approval, 12 months to build it. In terms of, we're in discussions with a number of users already. You've got 4 Pines who have been operating in Orange for almost 10 years. They're keen to move in and take a greater space. I think tenancy number 2 led to a medical use. And then number 3, I think, we're aware of probably up to 10 national retailers that are looking for, more than 650 square metres, which is a big tenancy, very hard to find. And we've started discussions with several of those already.
And as you mentioned earlier, you've got 125 tenants across your portfolio, so I'm sure that opens the door for those kind of negotiations on new spaces like this as well.
Definitely on the medical side, we've got a number of pharmacies and medical tenants in the portfolio, and one definitely stands out for tenancy too. But also, Dylan, probably I should a pretty straightforward development, as John said earlier on, complying for planning purposes, regular in shape, good loading, access off of the Summer Street as well as Sale Street. So a pretty simple complying project for ourselves.
Yeah, thank you. But obviously a highly profitable one there, as you can see, with the passing income jumping by 35% and the valuation by 51% forecast post that expansion. Moving on from that, John, did you want to just provide a bit of a summary and the key takeaways from the opportunity?
Yeah, thanks. And it's been a good overview, Chris. And look, really, it's kind of just reiterating what I said earlier. You know, a great, in my view, risk return profile. You know, really pretty defensive income with basically a fully leased centre with you know, value add on a small component on what's a pretty straightforward development. I mean, no development's easy, but in terms of ones you'd want to do, this is certainly one, and that really provides you know, that drives that IRR return and equity multiple. You know, the existing asset is very strong. You know, high percentage of non-discretionary spend, anchored by good tenants, had a recent upgrade. You know, one of the best Dan Murphys in the country. That's pretty good ingredients. And then at a macro level, really a really great location in the middle of town in a growing, you know, in a growing centre. And really one of the stats that stood out for me was that growth in house prices, and I think that really drives wealth in the town, which drives ultimately retail spend, which is good for retail. So, you know, overall, I think a really great deal, good risk return profile, and we're pretty excited about it, and looking forward to partnering with Parkstone on this second transaction with them.
Yeah, thanks, John, and thanks, Chris. And before we get into a couple of the questions that I've seen come through, I might just give a bit of an update on the next steps. As you can see here, we require about $20 million of equity to acquire the asset, which is due to settle anytime from the 13th of December. We're about 60% subscribed already, only after a week of launch. So if you do or you are interested, please do reach out to Lyle, myself, or Nell in the details there, all through the link in the chat box that goes through to the funds landing page and EOI form. We're hoping to have the IM out to you early next week, and the applications will open at the same time. In terms of the questions that have come through, both of them look like they're for you, Chris. The first one's just on finance and whether you've had any discussions with the banks and what your target gearing is and what the appetite has been from those banks.
Yes, Dylan, we're well advanced. We've had keen interest from the leading banks who we've got existing relationships with. So we're well advanced with one of those specifically, but we've also had a fair bit of interest from other lenders as well, who have reached out. So we're pushing on with that, and there are emails coming through now just confirming those terms. And in terms of the LVR, look, the desired LVR is between 50 and 55, which is pretty comfortable with our lenders.
And Chris, it's probably worth just clarifying that the banks are comfortable with the development and happy to fund that as well.
Very comfortable with Orange, John, and obviously we've got an existing centre there with one of the banks, so there's been no shortage of desire for the banks to get involved.
And sorry, Chris, one last question has just popped through as we're running through those. What do you see as the major risks of this transaction, and what are we doing to mitigate them?
I think, Dylan, with the key risks, you would have to look at the majors, the performance of the majors, and the likelihood of them not renewing. Now, we already know that, you know, Dan Murphy's is an outstanding store, so that's highly unlikely. The IGA is doing very well, looks fantastic. So, you know, the risk of that is minimal. In fact, you know, you're more likely to have the situation where Coles or Woolworths or one of those competitors, you know, knock on your door to see if they could take that space. So I would say they're negligible. And obviously with the expansion of the centre, you know, as soon as you contemplate development. There's development risk, and at the moment that's predominantly around the costs of construction. I would say that we're, Parkstone's in the middle of multiple refurbishments and expansions with more to follow next year. And we're across the costs like intimately in terms of what it costs to build these centres and how they stack up. So I would say that we're comfortable and that we've been very good at mitigating that so far, Dylan.
And ultimately, we wouldn't go ahead if we did all the planning work and at the time the development didn't stack up. But I think the numbers are pretty supportive of it.
No, perfect. Thanks, Chris. And we'll wrap that up there. And again, I just wanted to say thank you to Chris and John and everyone that attended today's webinar. If you did have any other questions, please don't hesitate to reach out. Otherwise, like I said, I recommend reserving an interest or requesting more information as soon as possible, because we are progressing well with the capital raise to date. So thank you, and hope you enjoy the rest of your day.
Cheers, guys. Thanks.